Well, good afternoon and welcome to the quarterly Tax and Super Update webinar for March. Josip and myself are here presenting for I suppose the most recent events that have occurred sort of in the tax and superannuation environment over the past little while. Now, I suppose for those that are looking for some crystal ball gazing in relation to the budget, unfortunately our crystal ball is a little bit fuzzy. It's a bit clouded. It doesn't really tell us a lot what may or may not be in the budget. However, the gut feel is that essentially there's not going to be much in it. Essentially, from a tax and superannuation point of view, they have a tax white paper bubbling along in the background, and essentially the government will let that run its due course until such time as it's gone through the consultative process, and then come next budget, which happens to be 6 months before an election, they might make some more radical and wholesale changes to what we currently have as our tax and super systems. So I'm not really expecting there to be too much on the 12th of May. And also, I suppose as a quick note on that too, we will be having a webinar on the 13th of May that's covering the content of the budget around lunchtime again, as we usually do. So if you're interested in finding out what is actually in the budget, then by all means, when you receive the email to subscribe, please click on the link and register, and look forward to joining us for that particular webinar. Without further ado, we'll move on. So I'll hand over to Josip to talk about the most recent updates in relation to taxation.
Thank you, Brett, and welcome everyone. I guess the first slide, the Senate Economics References Committee is conducting an inquiry into corporate tax avoidance. I guess the committee is looking at the tax avoidance and aggressive minimisation by corporations registered in Australia and multinational corporations operating in Australia. It is due to report to the government on the 1st of June 2015. You might have seen in the press that I guess Apple and Google have put up their hands saying that they have been had the ruler run over them by the ATO. I guess the committee has received many submissions along the way, including some from the ATO. So some interesting points that the ATO have made in the submission. I think they're quite interesting stats. For public and foreign-owned companies in 2014, the ATO only ranked 1 as higher risk under its risk differentiation framework model. This number is down from 13 in 2011. Some 307 companies were rated as medium risk, down from 380 in 2011. The ATO says its risk differentiation framework model runs risk models over 100% of the population concerned. Of the ATO's total higher risk and key taxpayers, there are currently 24 foreign-owned taxpayers. The ATO says it continues to build a catalogue of base erosion and profit shifting structures and arrangements. The terminology I use is BEPS, used by multinationals. At present, there are 11 broad BEPS typologies, and the ATO says it uses these in conjunction with other profit shifting risk models to detect international risk and ensure that adequate level of investigation is undertaken. The current revenue risk the ATO says it is seeing include transfer mispricing, thin capitalisation, complex financing arrangements, sometimes employing hybrid structures or instruments that result in stateless or untaxed income, and digital business platforms that have had large economic presence and in a jurisdiction relative to their tax contributions. The ATO says that more than 70% of the risk currently being addressed in public groups and foreign-owned corporates are international. The Tax Laws Amendment Research and Development Bill of 2013 was passed on the 10th of February by the Senate. It included, I guess, 2 amendments moved by the Palmer United Party. Those amendments provide for, I guess, reduced tax offset for expenditure above $100 million. The amendments can introduce a cap of $100 million on the amount of R&D expenditure that companies can claim as a tax offset under the R&D tax incentive. For expenditure above 100 million, companies will be able to claim a tax offset at the company tax rate. The bill received royal assent on the 5th of March, so this is now law. So the amendment will take effect from the income years beginning on or after the 1st of July 2014. On the 23rd of Feb, the Australian Charities and Not-for-Profits Commission, or the ACNC, announced it will revoke the registration of up to 1,400 charities for not lodging the annual information statement for 2 consecutive years. So again, this is, if you've got some of these clients in your client base, you do need to maintain or make sure that they are maintaining these records with the ACNC. The 1,400, they call them double defaulters, had 28 days to submit their 2013 and 14 annual information statements, or they would have their charity status revoked on the 30th of March 2015. So that date has passed. The ACNC warned that an additional 7,000 double defaulters may have their charity status revoked by the ACNC in the coming months. The ACNC noted that charities that have their status revoked by the ACNC will lose access to the Commonwealth charity tax concessions, such as income tax exemption, FBT rebates, and the GST concessions. Taxation ruling 2015-1 was released on the 25th of Feb. It outlines the special conditions that various entities listed under the Division 50 of the 1997 Act must satisfy for their ordinary and statutory income to be exempt from income tax. It considers 2 of the special conditions that entities must satisfy, namely that the entity must comply with all of the substantive requirements in its governing rules, and that the entity must apply its income and assets solely for the purpose for which the entity is established. The ruling notes that the governing rules condition and the income and assets condition are independent special conditions that must be satisfied in order for an entity's ordinary and statutory income to be exempt under Division 50. And breach of either or both of the conditions will mean that the entity's ordinary and statutory income will not be exempt. It does not consider other special conditions in Division 50. Among other things, the ruling applies to registered charities, scientific institutions, public educational institutions, funds established to enable scientific research, societies, associations or clubs established for the encouragement of science, societies, associations or clubs established for community service purposes, employee associations or employer associations, and funds contributing to, other funds, so ancillary funds. With, the recent cyclone activity up north, the ATO has issued a message to taxpayers who have been affected by these weather events. For people that have a business or a residential address in the affected postcode, so those are listed on the ATO website, the ATO has stated that it would automatically fast-track its refunds out to those clients affected, and deferred the lodgement and payment dates, excluding the large PAYG withholders, due in February and March to the 28th of April. So you may have seen that on some of your clients. That's automatically populated. I know in some cases, and within my client base, it has already. People outside of the affected postcodes who have been impacted and need tax assistance can still call the tax office on that number, that 1-800-806-218. The privacy tax file number rule of 2015, it's now known as the TFN rule, was registered on the 4th of March. It regulates the collection, storage, use, disclosure, security and disposal of individuals' tax file number information. A breach of the TFN rule is an interference with privacy under the Privacy Act. Individuals who consider that their TFN information has been mishandled may make a complaint to the Privacy Commissioner. Essentially, the TFN rule replaces the previous tax file number guidelines of 2011 and contains 2 key differences. The first one is the title of the instrument uses the word rule rather than guideline. So interesting. And the second one being the TFN rule explicitly authorises the use and disclosure of the TFN information by a TFN recipient for the purpose of giving an individual any TFN information that the TFN recipient holds about an individual. So they're the two key differences. On the 13th of March, the Commissioner gazetted a notice that states that the ATO will continue to acquire details of entities that receive contractor payments from other businesses for the 2013-14, the 14-15 and the 15-16 financial years. This is the continuation of an ongoing program where this data will be matched from that has been obtained from businesses that are subject to compliance activities conducted by the employer obligations area within the ATO. Data may also be collected from other businesses associated with primary businesses. I've had a case of this, I guess, this month, where a client was, I guess, subject to an employer obligations audit, and I guess the data they were after was the ABN of each contractor, name, address, telephone number, dates of payments, and I guess amounts paid. So expect that if a client was going to go under an audit through the employer obligations area, that they would be needing to supply this information to the ATO. It's estimated that records for approximately 25,000 entities will be obtained each year, including the records for approximately 12,500 individuals. These records will be electronically matched to certain sections of ATO data holdings to identify non-compliance with registration, lodgement, reporting and payment obligations under taxation laws. Right, the Tax and Superannuation Laws Amendment 2014 Measures Number 5 Act of 2015 amends the 1997 Tax Act by repealing Subdivision 61K and amends Taxation Administration Act 1953 to abolish the mature age worker tax offset from the 2014-15 and later years. In place of the offset, a new expenditure program being delivered by the Department of Employment Restart will provide alternative support by way of a subsidy of up to $10,000 to employers who hire mature age job seekers. The bill also amends the 1997 Act to update the list of specifically listed deductible gift recipients. Okay, employee share scheme. So there's been a bit of tinkering with this during the, I guess, the first quarter of the year. The Tax and Superannuation Laws Amendment Employee Share Schemes Bill of 2015 was introduced to the House of Reps on the 25th of March. The bill proposes to amend the 1997 Tax Act to improve the taxation of employee share schemes, or ESSs, by reversing and improving some of the changes made in 2009 to the taxing point for rights for employees of all corporate tax entities, introducing a further taxation concession for employees of certain small start-up companies, and supporting the ATO to work with industry to develop and approve safe harbour valuation methods and standardised documentation that will streamline the process of establishing and maintaining an ESS. I guess the bill proposes to generally apply to ESS interests acquired on or after the 1st of July 2015, so it's not retrospective. To give you an idea of, with respect to reversing and improving some of the changes made in 2009 regarding the taxation point of the ESS rights, currently where an ESS right is subject to deferred taxation, the taxing point occurs at the earliest of one of the following 4 points in time. One, when the employee ceases the employment in respect of which they acquired the right. 2, 7 years after the employee acquired the right. And as a result of this bill, this is being amended to increase the time period from 7 to 15. And then 3, where when there are no longer any genuine restrictions on the disposal of the right and there is no real risk of the employee forfeiting the right. Or 4, when there are no longer any genuine restrictions on the exercise of the right or resulting share being disposed of, and there is no real risk of the employee forfeiting the right or the underlying share. Again, as the result of this bill, this is also being amended to now read when the right is exercised and there is no real risk of the employee forfeiting the resulting share and there is no genuine restriction on the disposal of the resulting share. If such risk or restrictions exist, the taxing point is delayed until they lift. I guess this slide's about the body corporates and some of the changes that have happened over the quarter. The ATO released a draft tax ruling 2015 D1 on the 25th of March, which explains the specific income tax issues that affect body corporates constituted under the strata title legislation and proprietors of a lot held under that legislation also. I guess broadly the draft states that a strata title body is a company for income tax purposes, and the Commissioner has a discretion to treat the company as a public company for the purposes of Section 103A, subsection 5 of the 1936 Act. It also examines in detail the assessability of the income and the deductibility of common expenses. When the final ruling is issued, it's proposed to generally apply from both before and after its date of issue. As a consequence of this draft ruling, the ATO has withdrawn, I guess, income tax ruling IT 2505, bodies corporate constituted under strata title legislation, and the following tax determinations with effect from the 25th of March. So TD 92-181, TD 93-7, TD 93-73, and TD 96-22. The ATO has also withdrawn a number of IDs, as the ATO says the issues contained in the IDs are considered in the draft tax ruling 2015 D1. I guess wealthy individuals, are in the sights of the ATO. The ATO says it's taking a prevention before correction approach and ramping up face-to-face engagement with key taxpayers. Again, we've started to see this happen. So since the announcement, we've seen some, spot visits on some clients. Again, it's just a more getting to know you sort of approach and making sure that, all areas are compliant through various lines of questioning. Acting Second Commissioner Michael Cranston said that the ATO will be visiting the largest private groups to look at their tax affairs in real time, raise any concerns and resolve issues before companies lodge their tax returns. According to the ATO, about 30% of wealthy individuals and their private groups are considered high risk. Mr. Cranston said there was about 175 private groups controlling almost 6,000 entities with more than $1 billion in turnover or $500 million in net assets. He said the ATO will begin visits by the end of the month. Again, I have seen it with people dropping, the ATO dropping into certain clients. As Brett mentioned before about the white paper process, so this is the consultative process that the government is having to, reshaping the tax system in the future, which is probably why we have the opinion that nothing groundbreaking is going to change this time around, but we'll see what comes out at the other end of this, this tax discussion paper. So Joe Hockey released a tax discussion paper on the 30th of March as a part of the tax white paper process. Joe went on to say that the paper begins a dialogue on how we create a tax system that supports higher economic growth and living standards, improves our international competitiveness, and adjusts to a changing economy and new opportunities. He said the problem we face is that our current tax system, which is designed before the 1950s, is ill-suited to the 2050s. I tend to agree with this statement, so it'll be interesting to see what this process actually does dig up. Joe then went on to add that a result of changes driven by globalisation and the rise of the digital economy, Australia's heavy reliance on income taxes may be unsustainable. He said that the over-reliance is projected to increase further, largely as a result of wages growth leading to individuals paying higher average tax rates through, bracket creep. The Treasurer also then went on to say that we need a more competitive corporate tax regime to encourage investment. Following this community consultative process, the government plans to issue a green paper covering tax options due to be released in the second half of 2015. The government will seek further feedback on those options before putting forward policy proposals in the white paper for consideration by the Australian people in 2016 ahead of the next election. So this is why we tend to think nothing exciting is going to happen in this budget, but we'll wait and see what happens next year. The 203-page tax discussion paper is available on the government's bettertax.gov.au website. It has a similar look and feel to the Newman Government Strong Choices website. We all know how well that went. The paper contains 66 questions for community consultation. Some of the questions posed are quite interesting. I thought I'd read out just a few. What should our individual's income tax system look and why? Under what circumstances is it appropriate for assistance to be delivered through tax offsets? To what extent is the rationale for the CGT discount and the size of the discount, is it still appropriate? To what extent does the dividend imputation system impact savings decisions? Do the CGT and negative gearing influence savings and investment decisions, and if so, how? How appropriate are the tax arrangements for superannuation in terms of their fairness and complexity? How could they be improved? How important is Australia's corporate tax rate in attracting foreign investment? How should Australia respond to the global trend of reduced corporate tax rates? To what extent does the tax treatment of losses discourage risk-taking and innovation and hinder businesses restructuring? Would alternative approaches be preferable, and if so, why? How can tax avoidance practices such as transfer pricing be addressed without imposing excessive regulatory burden and discouraging investment? Does the R&D tax incentive encourage companies to conduct R&D activities that would otherwise not be conducted in the absence of government support? Would alternative approaches better achieve this objective, and if so, how? So I guess that website, if you want to have a say in, I guess, how the tax system is shaped, it is quite an interesting document to read. There is a nice little questionnaire that you can fill in that basically determines your answers to a series of those questions. So you can make submissions through that website by the 1st of June, and it will all those will be sent towards the Tax White Paper Task Force. And that's pretty much it from me. I'd like to now pass it over to Brett to discuss the quarterly happenings in superannuation.
Yeah, thanks, Joe. Well, to be honest, there hasn't really been a lot going on within super over the past little while, which is, in some ways, it's a nice thing. But I suppose what has come out has been rather relevant for certain taxpayers and superannuitants. So obviously we'll go through those. So firstly, the tax office has updated their website for the 2016 financial year rates and thresholds. Now this is a great indication of where what's going to be in the budget as far as the contribution caps and that sort of thing goes, because in the past the tax office don't update these figures when they're changed or not changing in the budget, as the case may be. So the fact that they've already released these figures basically means that there will be no changes to the concessional and non-concessional caps in the budget in 3 weeks' time. So as by way of summary, the concessional cap, so where a tax deduction is claimed either by an individual or by an employer, the concessional contribution amount is $30,000 if that person is under 50 years of age. If they're over 50, then the temporary contribution cap is $35,000. Now, between the ages of 65 and 75, there is a work test that individual needs to make, or meet, sorry, which is 40 hours and 30 consecutive days. And that needs to happen prior to the contribution being received by the superannuation fund. Now, as the non-concessional cap is essentially a formula of the general concessional contribution cap, being 6 times of that rate, therefore the non-concessional contribution cap is $180,000 again. And the bring forward, still 3 years into 1 year if you like, which is so long as you're under 65, at $540,000. So if you utilise that facility, it means that you can make the $540,000 contribution in 1 year but then you're essentially prohibited from doing so for the next 2 subsequent financial years. Super guarantee, it's remaining at 9.5% of ordinary time earnings, so once again no change there. That's actually frozen for a couple more years yet. One thing that has changed though is the maximum contribution base. So this is where an employer is not actually required to pay superannuation guarantee contributions above a certain wage figure. And for the 16 financial year, that'll be $50,810 per quarter. So essentially, if someone is earning $300,000 a year, the employer is only required to pay SGC of up to $50,810 a quarter. Because obviously SGC needs to be paid on a quarterly basis. Now, if an employer does utilise that facility, if you like, then as an individual, you want to be going to that employer and basically negotiating a higher salary, because essentially they are jipping you for 9.5% of what you would otherwise be entitled to. Some threshold changes that will be coming through in the 2016 financial year. So the lump sum low rate cap will increase to $195,000. So this is basically a lifetime maximum amount that a superannuant can receive in their own hands from a superannuation fund as a lump sum amount. Now, to get a little bit technical about it, it's actually the taxable component within inside a superannuation or a superannuation interest for a member. So typically that may be 100%, it may be less than that. So to utilise that $195,000 cap, the individual may actually have to take out more than $195,000. So and that's very much on a case-by-case basis. Now obviously you still have to meet a condition of release and your preservation age before you're able to utilise that lump sum low rate cap. So it's not something that's open for everyone. Another threshold that's increased is the CGT cap amount. So that's increased to almost 1.4 million. So subject to satisfying certain criteria, this is an amount which can be essentially transferred into superannuation without any tax consequences. So there's a fair few hurdles that need to be applied though to utilise that. But just so you're all aware, there has been a slight change in that one too. Probably the biggest item that's occurred over the past little while is a new legislative framework around excess non-concessional contributions. So previously, if you had an excessive non-concessional contribution amount, there was only one mechanism in which it was dealt with, and that was tax at top marginal tax rate. So if you or your client was unfortunate enough to put, say, $100,000 into super as an excessive non-concessional contribution amount, then that was actually taxed at top marginal tax rate. So by doing that, you're basically giving the government half of it, which isn't a very nice outcome. In the last budget, they actually announced that they'll be making some changes to how this works. And they gave some loose frameworks around it, but obviously now that we have legislation, we're able to talk a lot more specifically about what that really means. So on the 3rd of March 2015, the Tax and Super Law Amendment 2014 Measure 7 actually made it through both Houses of Parliament, one of the few bills that I think actually has from the last budget. And what that actually, and with that, there are draft regulations for the SIS Act and regulations that also allow for this mechanism to work. Because obviously when you're dealing with this sort of thing, there's the Tax Act and the tax consequences that need to be dealt with, but there's also the superannuation issues about early release and access of superannuation benefits that also has to be covered off. And that's what those regulations do. So the regulations essentially will be in line with the draft regulations that we have now, and they'll basically be finalised when the legislation receives royal assent. So what this really means is that if someone puts in an excessive contribution amount, they're able to withdraw that amount from superannuation along with 85% of this magical number that they've come up with called associated earnings. Now basically this associated earnings is included in the individual's tax return and taxed at their normal marginal tax rate. However, they are also entitled to a non-refundable 15% tax offset. So associated earnings is essentially a calculation that's based on the average general interest charge or GIC rate for each quarter of the financial year in which the excessive non-concessional contribution was made. So and I suppose the big kicker here is regardless of when the contribution was actually received by the superannuation fund, the calculation goes back to the 1st of July of that particular financial year. Now, to give you an idea, the GIC rate for the 2014 year equated to about 9.66%. So it's almost in line with credit card rates, but not quite as good as your home loans. And the important thing to note with this as well is that the individual has 60 days in which to make an election. So I've got an example coming up that basically goes through the, I'll call it the rigmarole that's involved in this sort of process. So basically, if an individual elects to release the amount, then the entire amount that was excessive contributions, along with this 85% of the associated earnings, is what's released. If they don't do anything, or they don't meet that 60-day test, or make the election, I should say, within the 60 days, then basically they will have to pay the tax personally. So they won't have the ability to pull money out of the superannuation fund. They will lose half of it to the taxman. So not a good result. So by way of example, and this goes over a few pages, but I thought I'd go into a bit of detail just to make sure that we step through all the processes. So in this example, let's assume that a member makes a $100,000 excessive non-concessional contribution in, say, June 2014. Because this legislation, it is retrospective. It goes back to it includes the 2014 financial year. So essentially, it's in effect from 1 July 13. Now, the ATO, or through the reporting mechanisms, the ATO have determined that yes, there was an excessive contribution, and they do that on the 1st of January 2015. So the contribution was received by the fund in June 14, in the 14 financial year. However, the ATO make the determination on 1 January 2015. And they basically say that the amount in the determination is $112,316.50. Now, how that's calculated is the $100,000 excessive contribution. That's easy. But this is the associated earnings calculation, and for this I've just assumed the 9.66%. That is actually, that $12,000 odd amount is made up of the 9.66% for the 2014 year. So remember, it doesn't matter it was made in June. They go as if it was made from 1 July. So that's $9,660. And then basically half of that amount for up until 1 January 2015. So from 1 July 2014 through to 1 January 2015, and then the previous financial year. That equates to about $14,800, and then you take the 85% of that. So in this particular case, obviously, the member decides they want to release within their 60-day time period. So the member makes a valid election to release by notifying the tax office and also referring to their superannuation fund in that release form that they receive from the tax office. The ATO then issues the member's super fund with a release authority, requiring the fund to make a payment to the member of that $112,000. So it comes from their superannuation account to them individually, so to their personal bank account. So the amount's paid to the member by the fund in compliance with the release authority. The amount is then treated as a non-assessable, non-exempt income to the member, so that means that there's not a taxing point at this stage for it. The super fund notifies the ATO and the member that they've actually made the payment. And now the tax office will include the associated earnings amount of $14,490 in their assessable income. Now, remembering that the individual actually only received $12,316, but they're being assessed on $14,490. The reason for that is that there is a non-refundable tax offset of 15%, or in this case, of 15%. So it's a bit of rigmarole as to exactly how it all sort of ties together. But that's basically the process, and the ATO will just issue an automatic assessment, so the individual doesn't actually have to lodge an amended tax return or anything like that. It just basically happens. So that's obviously a fairly big change from what we've had, and saying that, it's a far better outcome than what we used to have also. Because the way that the contribution cap and the non-concessional contribution cap work is that if you have a situation where the concessional cap is breached and then the non-concessional cap is breached because of the same contribution amount, then there's the potential of paying a 93% tax rate under the old regime. Under this regime, at least you're limited to an associated earnings amount being treated as assessable income for the non-concessional contribution. Now, obviously, there is other mechanisms for the excessive contribution that have been introduced, which are along similar lines to what this is now. So it's certainly a positive move forward. Draft legislation was released in January 2015, so Tax and Super Law Amendments Measure 2, and it was titled Instalment Warrants. Now, the reason why I've mentioned this is that although it prima facie more talks about instalment warrants, which may be for shares and those type of product, it also relates to limited recourse borrowing arrangements, because for those of you who like to play legislative bingo with superannuation law, the limited recourse borrowing arrangements are technically an instalment warrant or a derivative product. So the fact that the the Treasury have released this draft legislation, I think is a very strong indication that the government don't have any plans afoot to change limited recourse borrowing arrangements with inside superannuation, or certainly they have no plans on banning them completely. They may try and ring fence them and make them a little bit tighter, but typically you wouldn't go through a legislative process if you're then going to can something. So what this draft legislation effectively does is that it confirms what most people should already be doing, so essentially the status quo. And that is, for tax purposes, that a limited recourse borrowing arrangement asset is treated as if it is owned by the superannuation fund. So that's for income tax and capital gains tax. So basically, the bare trust or the custodian trust, holding trust, whatever name that is basically put on the label, is ignored for tax purposes. and it is 100% treated as if it is a superannuation fund asset. So really, all this does is crystallise or confirm essentially what should have already been happening. Certainly, it's what we've been doing for since legislation came in. Related party loans. Now, this goes back to December. The ATO gave us some Christmas presents where they decided that over the Christmas break we needed some light reading, and they issued two IDs, 2014 39 and 40. Now, essentially, these related both to limited recourse borrowing arrangements where a related party was involved. Now, of course, the examples that they used for these interpretive decisions was fairly straight up and down, very clear cut, essentially. So it doesn't really give a lot of guidance to the middle ground, but it certainly confirms, I suppose, the ATO's viewpoint and what they're really looking for, given a certain particular set of circumstances. Now, once again, for those of you who enjoy this sort of beating your head against the brick wall with superannuation legislation, this issue has been bubbling around for a very long time. And these is actually the first time the ATO has committed, I'll say in a more of a public forum, in relation to these type of arrangements. Previously, they have been asked the question in a national tax liaison group, which is basically a meeting of tax and super people around particular issues. This was discussed as one of them. And there are also private binding rulings, which is where you go to the tax office and say, hey, this is our situation, what do you think? And previously the tax office held the position that there would not be an issue with having arm's length arrangements for borrowings. They've substantially changed, let's call it a backflip, their position on how they're treating it. So yes, they have confirmed they will not be treated as a contribution. So that's a good thing. However, what they have said is that if you don't get it right, there is the potential to treat it as non-arm's length income. When a superannuation fund receives income that is deemed to be non-arm's length tax rate, and that is regardless if the fund is in pension phase or not. So it's actually put in a separate part of the tax return and it is taxed at top marginal tax rate. So it's a pretty nasty outcome, particularly since if you have an asset that you have acquired in the super fund that is generating, call it $100,000 worth of rent, the tax officer essentially saying that the fund would not otherwise be able to enter into the arrangement unless it obtained this favourable related party loan. Therefore, they treat the whole $100,000 as non-arm's length income and therefore tax it at top marginal tax rate. So 50 grand out of the kitty, which is not a very nice result. So the things that basically are considered in relation to this is the nature of the asset acquired, the amount that was borrowed, the term of the loan to value ratio or the LVR, the interest rate that's charged or any other means in which the lender is compensated, the frequency of the repayments, the security that's been taken, the extent to which the loan has been operated with. So in other words, if the agreement actually says it's paid monthly, the principal and interest is paid monthly, they actually have to pay the principal and interest monthly, things like that. So essentially, it is as if you are going to a bank and obtaining a loan. That is the criteria that the ATO have set around this. And that's the easiest way to think about it. Insofar as you should either match the interest rates so they are akin to what you can get from a bank, or certainly the terms and conditions, so the LVR and things like that, should all be as if you could go to a bank. I know some clients that I speak to, I actually suggest that they go to a bank, obtain some information if they would lend on that basis, and when they say yes, of course we would, get that in writing, and then use that to replicate for their own arrangement. Otherwise, other times it may just be a file note or a minute that's put together that refers to research that they've done or that sort of product to say that yes, it is a replicating an arm's length arrangement. A bit of an obscure one, but I thought I'd throw it in anyway. The draft amendments to the anti-money laundering rules. Now this has actually been kicking around since 2011, so that's why I thought I'd throw it in. It just goes to show that some things never go away quickly. Basically, the proposal was that, or there was a concern that self-managed superannuation funds were being used for money laundering to finance terrorism. So what they were proposing is draft amendments that would require reporting entities to carry out a full customer verification and identification check to make sure that everyone is who they say they were and that it was all being used appropriately. So this is essentially the 100-point test that you may experience if you get home loans and things like that. Now, fortunately, Austrac have decided that they won't be proceeding with this because presumably they've realised that the risk of someone rolling money from an APRA-regulated fund to a self-managed fund to then engage in terrorism funding or financing is fairly remote. So some red tape, we've been saved from some red tape there, which is a nicety, let's say. A couple of court decisions that have been handed down recently that I thought were of particular interest to the audience. One is a Queensland Supreme Court decision that was actually handed down just on a month ago, where in Munro and Munro, that relates to a binding death benefit nomination. So essentially, Mr. Munro, who unfortunately passed away, he was a solicitor that had completed his own binding death benefit nomination. Now, unfortunately, he had put on that binding death benefit nomination trustee of deceased estate. So what that means is that, so he put trustee of deceased estate. So when he died, there was a dispute about if that could actually be paid or should be paid in accordance with that nomination. And it went to the Supreme Court, and they actually held that the binding nomination was not valid as it did not comply with the requirements of the trust deed. Now, the court emphasised the fact that the binding death benefit nomination would have only been binding if it strictly complied with all requirements of the trust deed itself. So essentially, this is, I suppose, strong justification that as an accountant, I do not prepare binding death benefit nominations. They are a legal document. In this case, we had a solicitor who got it wrong. So it goes to show that as part of a broader estate planning review and strategy, that things need to be done properly by people who actually understand what they're doing and the implications of what they're doing. So in this case, the nomination, because it was to the trustee of the deceased estate, the court determined that it was not as it was not the nomination of the deceased legal personal representative as required by the trust deed, then basically it failed. So as a result, the trustees of the self-managed super fund could pay the death benefits as they saw fit, rather than in accordance with the binding death benefit nomination. Another recent case was actually from the AAT, or the Administration Complaints Tribunal, where the ATO's view about self-managed super funds offsetting tax losses came into play. So when a superannuation fund pays a pension, that income generated by the pension is actually non-exempt income. And I suppose the long-held belief is that tax losses must first be applied against the non-exempt income, so in other words, the income attributable to the pension, before the tax losses are used. Obviously, in this particular case, the taxpayer tried to use the exempt pension income calc first and carry forward tax losses that they had from their tax return. The AAT sided with the ATO in this case, and effectively that means that tax losses are essentially not available for deduction against the excess assessable income. So in other words, you use up your exempt pension income first and then tax losses. So it's basically the way that the tax return works, but the idea is that it's not deriving, you're going to minimise any potential carry forward tax losses for the super fund. Because the idea is that basically if you're not earning taxable income, then you can't carry forward tax losses for that. And finally, just to touch on advisor licensing, there's been some interesting things that have come out over the last little bit in relation to that. So, by way of summary, there are three options that an accountant can take to ensure that they can talk about self-managed superannuation. So the first one is to become an authorised representative of a licensee, which, as a side note, is what all the tax and business solutions directors here at Vincents are doing. Attain a limited licence, which is a particular type of licence that ASIC have developed for accountants that only want to talk about a particular product. Or obviously they can do nothing, the accountant can do nothing, or essentially refer to someone else. Now, I thought this was interesting when you have Peter Neal, who's the ASIC Deputy Chair, basically commenting that accountants need to get their skates on in relation to licensing, because there's less than 18 months to go, and the uptake from accountants on the limited licensing aspect has been very limited, to say the least. In fact, there have only been 121 applications received so far, and half of those have actually failed. So at the moment, there are only about 60 limited licences that are in play. Now, initially ASIC expected about 10,000 accountants to go through the limited licensing regime. At the moment, obviously, 50 is a long way off that. Now, that may be that a lot of accountants are deciding to become authorised representatives, as I mentioned, like we're doing here at Vincents, or it may also mean that other accountants are setting up a referral base to refer clients on to someone who is actually authorised to talk about their situation. Now, as an accountant, you need to be very mindful of the fact that after 1 July 2016, you cannot refer or you cannot talk to a client about setting up a self-managed super fund, winding up a self-managed super fund, starting pensions inside a self-managed super fund, or for that matter, you even need to be careful about talking about making contributions into super, unless you put a particular spin on it, essentially that it's from a tax point of view. If you do so, then you are opening yourself up for a breach of the ASIC of the corporations law, and some pretty horrendous penalties, not least of which is the potential to be struck off as not a fit and proper person as a tax agent. So essentially you could have your career ending. So it's obviously a pretty big stick for an accountant out there, and obviously for a client it's worthwhile noting this, so that way if you're talking to an accountant or to a friend, then you need to make sure that they are actually authorised to talk to you about particular aspects too. So based on that, I think we'll end it there. If you have any questions, either Josip or myself, by all means, please email them through.